Welcome to TheoTrade. This is Don Kaufman. May 14th, 2021, minutes after the cash close here on this Friday afternoon, doing the weekend update here to answer the question, should I buy the dip or sell this rip? All right, we're just coming off a fairly volatile week in the marketplace. One of the things I'd like to do is just give you kind of a brief market recap. There are some areas of some pretty serious contention inside of this marketplace right now. And there's also some areas that, I don't mind saying this, just leave me completely and utterly perplexed. And that has nothing to do with the fact that we just ripped back up the last 2 days. In fact, for those of you that speak trader geek, how about this? If you take a look at the SPX and the expected move, and you guys know I look at the expected move just incessantly, we actually pulled back, all right, from Thursday and Friday. I mean, we were just got rocked on Wednesday outside the expected move. We pulled back literally right into the lower edge of the expected move. How close is it? Oh, how about we have a $4,173 product, the edge of the expected move. That's a line we drew last Friday. Was 41.71. We were a rounding error off hitting the lower edge of the expected move. First and foremost, I was talking about some areas that are perplexing. That isn't perplexing. That's just absolutely astonishing how efficient, if you will, this marketplace has become. And if you ever question expected move, yeah, look at a week where the S&Ps are getting tossed around, 150, 200 points, and then we end up literally hitting the bottom edge of the expected move. So with that, let's give you kind of this brief market update, but I want to talk a lot about a couple of trade opportunities that are setting up right now, and some areas. Again, as I said, there's some contentious areas in this marketplace. So obviously, what sparked some of the volatility throughout the course of this week were inflation fears, and maybe rightfully so, but I think the best way to look at the week as a whole, I like to use this 30-day 1-hour chart. Hey, listen, say what you will. I'm not a big market technician out there, but one of the things that this 30-day chart, I think, just so clearly kind of delineates is when we actually kind of entered into a very, very tight range inside of the overall marketplace. We broke outside that range, of brief and fleeting hope of actually smashing through the upside of it. And, all-time highs, literally we come off the all-time highs. And then by Wednesday of this week, it's just utterly hideous. We're looking at the exact opposite. We went from like, okay, I mean, everything's going to be fine, to we almost broke apart completely. By the end of this week, where are we? Pretty much right back in the central portion of this range, which, as I was saying, is kind of a week of volatility, and this is back in the volatility box. But before I go any further than that, when I say it's a week of volatility, okay, what we effectively saw in terms of volatility, a lot of people are not necessarily comfortable looking at the volatility futures, which I'll talk about here momentarily, but take a quick glance at the VIX. Okay, the VIX did shoot up a clear shot all the way into the 28, even almost the 29 handle, and then collapsed back down to 18 and change, which is, again, astonishing unto itself. You got to recognize the percentage moves that you're really seeing here. I mean, if you had a stock that went from like 17 to 29 and reverted back down, you'd be like, wow, it was a wild week. I mean, this thing's moving, 40% or so in a trading session. It's a little bit alarming, but the way to measure that, you talk about like a week of volatility, you got to look at the VVIX, all right? The volatility of the volatility index. And the reason you want to look at the VVIX is the volatility, okay, and how volatile is the actual VIX itself? And the answer to that is, again, one other just shockingly high reading this week was unquestionably the volatility index. Now, why do I bring it up? This is not going to be in past tense. I come in here each and every weekend, and I do like a little bit of an update. And I'm not giving you the update like, listen, this is, it's hindsight. Hindsight is always 2020. There's a reason I'm bringing up the volatility index. First of all, okay, the VVIX hits 150. I don't care if it reverted all the way back down to 117, okay? Damage was inflicted in this marketplace. When I'm talking about this topic, of this weekend update is, should I buy that dip or should I sell the rip? I'm going to say right off the bat here, okay, I'd be extraordinarily careful taking any long bias right now that you're not capable of quantifying the risk in. Meaning that, I wouldn't run out and be like, I'm gonna buy me some Tesla. I gotta jump on, those deals out there and stocks that are down. It's not that I wouldn't take a long position, and I don't want you to misinterpret. This is not, Don the Bear coming out. And yes, I'm always bearish. Let me just tell you right now, I am not actually the perma bear that you think I am. I've actually taken extraordinary bullish positions over the years. Nevertheless, all right, the reason I'm bringing up the VVIX and simply saying like, this isn't just like a big flash in a pan. Damage is done, right? For the VVIX to get this high, there was this tremendous number, okay, of call options in the VIX that traded, and they traded at ridiculously high levels because, well, the VVIX cleaned up to 150. And maybe this doesn't necessarily resonate with you, but this little, what you kind of think is, oh, it's just a little flash in the old pan over there. That's when you start opening up like 10-year charts though of the VVIX. And the VVIX really only comes back about 10 years, just shy of 10 years. And you can pretty much count, really on one hand, the number of times that it kind of spiked up this far, this hard. It's crazy though to see it literally happening. If you're looking back over here like, oh, it kind of happened over there. Listen, the market is just ultra sensitive right now in terms of the volatility index. All right. So the VVIX goes completely ballistic. But one of the things that left me just utterly perplexed is the volatility futures. All right. We talk about what's called a contango and backwardation. The volatility futures never actually flipped. And I'm still looking at this one and I'm like, okay, I saw enough sell side activity, and I'll highlight this for a moment because it's important that you guys actually understand this. We saw enough volatility, and we're looking at the June volatility futures versus the July volatility futures. And I want to really clarify June, okay, versus July. Then we'll actually throw even the Augies in here. That's August. And what you're actually seeing here, when I say they didn't flip over, the part that has me, again, very perplexed, look at the distance from June to July. All right, we're still, the volatility futures are priced like this, where you're at, 21, 25, and then the next series out jumps to 22.70, and the next one out is roughly, 23, 26. Why am I surprised? Because after a week of volatility, or even like Wednesday, you would expect them to either flatten out or actually look opposite, where this goes all the way to 27, then it drops back off to 26, and so forth and so on, where we actually flip over and we go from a contango into a backwardation. Why again do I bring this up? Because I've seen the VVIX fly before, and I've seen the VVIX hit 150 a couple times. But what I haven't really seen is the VVIX hitting 150 in the volatility futures. They just stared and laughed and looked like it was going to be nothing. The marketplace almost seems to have a degree of immunity, if you will, to some pretty serious volatility events. But the interesting thing is the VVIX saw it. It felt the fear inside of the VVIX. And again, that one, it leaves me perplexed. And I gotta tell you right now, I'm inclined to believe, and again, it doesn't matter if the VVIX got slammed down, I'm inclined to believe that, we opened up, if you will, a little bit of Pandora's box in terms of volatility. And as I said, we're back inside of this extraordinarily tight range that we've been in. This is also of critical importance. I say we're back inside of the tight range. Let's just quantify that range once again. This is what I started with here. And this actually cruises all the way back, okay, in time to, if you will, we'll just highlight a specific date and time and say April 8th. Here we are ultimately on May 14th, okay? We only broke outside of this box for a brief and fleeting moment to the upside. And I said on last week's video, you had Monday and Tuesday, literally said you have Monday and Tuesday to break down. Otherwise, we explode to the upside. This week, I'm going to tell you right now, this coming week, I'm not going to give you anything that's that, prolific, if you will, to the forward future. But this breakdown was some damage, and I'm going to actually show you where damage was in fact done. So the big question is that volatility spike over? The answer, in very large part, is it's coming effectively right now. But in short order, again, I would not, by any stretch of the imagination, take just pure long and short directional positions. If you're going to be on the directional bias here, if you're going to buy that dip or sell the rip, use spreads, mitigate exposure at this point, because yeah, it does not look like the volatility to larger degree is actually abating. Okay, here's why we believe that volatility is not necessarily over. Okay, sector rotations, they're over. What do I mean? Okay, the sector rotations themselves are over. Allow me to show you the QQQ. Now the Qs, obviously they bounced today. Yeah, but so did the financials. The financials bounced in a spectacular fashion. Okay. In fact, everything is moving, right, in relative cohesion. So all of a sudden, this big and, if you will, definitive shift has taken place. Almost everything that we saw in recent weeks, months, if you will, has been all about what I termed the rotation game, right? Every day we were coming in here. Let's get out of financials and into tech. Let's get out of tech into the financials. And if we're not going out of tech and into financials, well, we also have to buy the energy sector. And it was this constant tech, okay, versus financials kind of rotation. As I said, definitive shift has actually taken place. Correlation has gripped hold. When we talk about correlation and high correlation coefficients, I was talking about this on Wednesday night. You need correlation to get capitulation. And how ironic that literally on Wednesday we saw correlation to the downside. Now we've actually got a marketplace that's correlated to the upside. So with these correlations, as I said, a very large shift has actually taken place. So what's the problem? Okay, the problem is, what I'm kind of bothered by, bonds are actually moving with it. I'd love to hear an explanation of this. And people, I've been asking this some traders throughout the course of the day. You realize that correlation has kind of gripped hold and the sector rotations seem to be over. So what's my contentious area? The bonds in the last 2 days are in fact rallying. Okay, when bonds go up, where do interest rates go? Okay, this is the TNX. Interest rates go down. Bonds go up, interest rates go down. Who does not like lower interest rates? I love lower interest rates. I'll tell you who doesn't like lower interest rates. The financials. Except the financials exploded. Yeah? Are you perplexed? Because I know I am. All of a sudden, everything starts to move in unison. Nobody seems to care anymore. Nobody seems to care that the financials, right, are right now, this is the glue holding the entire marketplace together. And we're actually going to talk about this, quite a bit, because when I say this is the glue, right here, right now, the financials are unquestionably the most pivotal sector inside of the S&P. You say what you will about, the NASDAQ. It's Tesla, man. It's all about Tesla. Listen, the NASDAQ stocks, look how far off. I mean, this is more than a hop, skip, and a jump away from all-time highs, right? This is the monsters of tech. This is your Microsoft, your Apple, your Amazon, your Facebook, your Google, right? This is everything, this is what matters. It's Apple, baby. Look how far off the all-time high they are. Again, it's more than a hop, skip, and a jump away. So when you look at the S&P 500, you're like, yeah, man, it was tech that brought it up. No, it absolutely unequivocally is not. It's the financials. And the financials right now are bucking their own, if you will, indication, and that is interest rates are going down and the financials just don't care. They continue to actually bid higher. It's the most pivotal sector. It's the sector that has to be watched right now. Okay, cannot stress this enough. And to further this kind of conversation, all asset classes, when I say are moving in unison, the thing that I'm bothered by, listen, you got bonds today, they're rallying. You got commodities today, some gold, the metals are rallying. You got oil today, it's rallying. Okay, this, right, it's not just unusual. It doesn't feel right. And that's where, there's a lot of trading and like, I'm much more of a quantitative trader, but there's also deep inside of me that, that like trader voice that comes out and goes, this is all wrong, man. It's just all wrong. And there's a lot of that going on right now in my head. You see this rip and rally in the S&Ps and this rally back inside of the NASDAQ. By the way, the NASDAQ just got decimated. In fact, I'm supposed to right now show you some sector expected moves. Take a look at some of these expected moves. Okay, look at the expected move. You realize the QQQ still, okay, missed the edge of its expected move. So it missed. So the QQQs actually did in fact close outside the lower edge of the expected move, and the rest of the marketplace pulled back up into it. And as I said, that little like voice in the back of my head, like, it just doesn't feel right, doesn't look right. Now, it would be rare though, Okay. And again, if you really want that, like, deep directional bias, which I'm trying to give you, I think it would be rare to see. And this is where I'm kind of caught, between my brain and the quant side of me. We rally on the VIX, we fade heavily on volatility. It's weird to think like volatility could go rocketing back up, but I'm left right now wanting more. There's a lot of like, during this last week, there's some pretty serious and tumultuous volatility, but there's a lot of, if you will, like boxes, I kind of call it, that are unchecked. What are some of the boxes that were unchecked? I didn't see the volatility futures invert. Okay, the real sign of like, a hallmark of volatility, and that just didn't occur. What else? Well, the fact that all asset classes are moving in unison. And speaking of all asset classes, like I cannot stress enough. Everybody is, it's Bitcoin this and Bitcoin that. You're going to find yourself a new asset class. Yeah, that got tagged. That, that was before. I know there was an Elon Musk did it. Elon Musk screwed me. It was before that. Okay. The Bitcoin was actually moving in unison with the S&Ps. I was showing that earlier this week as well, before even the comments out of the Musk. Nevertheless, I said all asset classes moving in unison doesn't feel right. And I'll tell you why it doesn't feel right. I don't think anybody really felt that fear of the marketplace selling off. It did to me in very large part. It appeared that it was like a lot of like retail trade that was just knocking the S&Ps around and knocking the NASDAQ around, because most of the stocks that moved the largest in this past week of trade, they were the stocks that have been ultimately in play in a substantial way to the upside. Speaking of which, and I'm not actually saying, by the way, Amazon was substantiated to the upside. Amazon has been straight shot down. It's no surprise to actually see it get a little bit of a bid. Google hasn't caught a bid really since its earnings announcement. It finally caught a bid, right? Tesla can't get out of its own way. Today, it finally caught a bid. And the reason I'm bringing these up is I look at them and everybody's going to ask me, like, what do you think moving forward? I think this is a short-term rip. I think it's a short-term rip in the Teslas and the Amazons and the Googles and the Facebooks. But people, it doesn't matter what I think about the Amazons, the Google, the Facebook, and the Tesla, because I'm telling you once again, it's the financials. The financials are going to take the cake, which actually brings me, all right, to another absolutely critical point. And that's going to be, what we're going to be doing moving forward. We'll come back to that here in just a moment, right? So some of the sector expected moves as I was kind of cruising through. So I was showing you the SPX, and the SPX actually pulled literally back into the edge of the expected move. Then we cruised over to none other than the QQQ. We applied auto expected moves. It just missed the lower edge of the expected move. What about the Russell? The Russell, okay, Mr. Toad's wild ride, pulled back in the edge of the expected move. Speaking of the Russell, this is going to be opportunistic for trade very, very soon. I'm going to look towards things like gamma iron condors. See this range? Okay, we're going to smash outside of it, upside, downside. I'm going to be on the buy side of a shorter duration iron condor on that one. I want to be long gamma, okay, in the IWM. I want to be long gamma in the short term, okay, and I want to be short gamma in the longer term, which basically means look at the volatility in this sucker. You go all the way out here, it's like 27% IV, right? So I'm actually going to be buying some gamma in the shorter duration and selling some premium further out to help finance some of that. Because again, I think the IWM is actually going to crack through some of that. All right, before I actually give you the real forward look, little stock chop. A couple of stocks that I would actually say that are key and in play. Some of the financials. I wanted to start with the financials. Wells Fargo. Why am I looking at Wells Fargo? I mean, basically closing at, multiple year highs. By the way, you have to go all the way back to the financial crisis to actually see Wells Fargo at these particular levels. The same is true of none other than Citi. Okay, Citi basically sitting at highs. All right, it's the closing high, the recent closing high. Last but definitely not least, Bank of America. Why am I bringing these up? Listen, if you're looking for something to short, okay, it's the financials. If you're looking for something to short, it's going to be the financials. Because again, if we're going to come off, it's the financials, again, that have to come off hard and fast. All right, some other really dicey looks that I want to give you here. The XHB, which is actually indicative of the home builders, got smoked. All right, in 2 days of trade this week. Actually, if you open up the auto expected move, that thing is almost 2 deviations out. neither here nor there. What I wanted to really show you though, okay, is the XHB did get a strong bid back under it, but it really didn't unwind a lot of the damage that was done. I also thought it was very interesting when I looked at Home Depot. I was a little bit perplexed by this one. Home Depot actually faded. I know they have earnings coming out. Home Depot faded, ended up down 0.5%. Lowe's faded. These are underlyings, okay, that look like, again, they're going to continue to fall right in the near term. The only problem is both of them, in fact, do have earnings. I looked around at other types of like retailers as well. Nothing is insightful, but I was kind of perplexed by the fact that in a day that, roughly speaking, everything was up. All right, 2 odd stocks out. Next in the docket here, if you're looking on the long side of the marketplace, none other than Intel. Intel, it caught its first up move pretty much since earnings, but this has been a straight slide to the downside since all the way back on April 8th. There it is, that April 8th again. April 8th has been nothing but sell side activity. I mean, pretty much can count on a little bit of a rally in here, but if we're going to sustain, okay, any rally inside of the marketplaces, you can assume that Intel is going to be bid. And even if the S&Ps were to continue to sell off, I'd still assume that Intel probably get a little bit of a bid under it. All right, markets moving forward. First thing I want to mention, the Fed, okay? If you think that the Fed is going to come to your rescue, and we always have people that are sending me like all kinds of emails. They're like, the black helicopters are dropping money, buying S&Ps. I'll tell you right now, Fed's not likely to support. Okay, they're not likely supporting equity markets. Why? The Fed doesn't want to continue the inflation discussion. The Fed hopes the whole inflation discussion is transitory. What does that even mean? Transitory. It's here and then it's gone, right? The Fed is hoping that the whole inflation topic is dropped, because if the Fed has to actually fight inflation, they're going to have to move interest rates, or they're going to have to actually reasonably start to pull back on some of the bond buying they've doing and some of the mortgage-backed securities. They don't want to have to actually cool the economy off. They love it because they haven't reached what they term full employment yet. So I'm going to tell you, why would the Fed not support equity markets? In fact, quite the opposite. The Fed, all right, purely my opinion, wants those marketplaces to come down a little bit so that everybody then is quiet in terms of inflation fears, right? They want the inflation fears to subside. The best way to do that, knock 20 or 30% off those S&Ps and then tell me about inflation. It'll dissipate overnight because no one's going to feel like they want to spend, right? So it's a nice quiet way to do it in the backdrop. Those inflation fears, unfortunately, are going to continue to resurface if the S&Ps stay at these levels or higher. There's no question. This is going to be like, this merry-go-round of fears. What's the merry-go-round of fears? Well, COVID is still, maybe coming back around. The supply chain issues. The supply chain issues are going to lead to what? Inflation fears. And I mentioned COVID because it might be, partially over and done with here in the United States, but it's not around the world. And that's going to continue to break supply chains. And of course, the inflation fears are going to resurface. Bond range. Let's come over to the bond range. It's way too quiet for me. It's just way too quiet. Bonds are going to start to break out. It doesn't matter which way they go, right? And I just want to clarify this. If the bonds right now were to break to the upside, that is going to take interest rates where? What? If bonds go up, interest rates go down. So if the interest rates go down, it's not going to help the financials. It'll break the back of the financials and sell off the S&Ps. But if the bonds start to sell off and interest rates really start to heat up, that's going to kill tech. I think we're finally ready to rock in the bonds. Get ready to rock in the bonds, which is going to be a huge and wicked dynamic coming up in this marketplace, which is another reason when I'm talking about buying the dip or selling the rip right now. Again, I can't find too many reasons to be like uber bullish on the marketplace with everything that we've faced. All right, last but definitely not least, the SPX, the mother of all products. Inside of the SPX, we have expected moves. Last week, we had a $61.63 expected move. We smashed through the lower edge of the expected move, literally came all the way back up. I want to reiterate, absolutely astonishing. We closed basically within what? Within $2 of the edge, the lower edge of the expected move. Spot on! This coming week, we're actually moving into almost an $80 expected move. So put on your big boy pants. Yeah, the volatility is going to be bigger. It's not as huge maybe as it was on Wednesday. But yeah, you're going to be out there and paddling out into some bigger waves this week. So make sure that you keep contract size small. Again, I think that volatility is far from over. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.